Welcome to the latest episode of The Bridge by iCapital. I'm Sonali Basak, the Chief Investment Strategist at iCapital, here to bridge you to the world's largest investors and the deepest thinkers in finance. And today we are joined by Vivek Bantwal. He's the co-head of private credit at Goldman Sachs with $188 billion under management. Vivek, thank you for joining us today. Private credit is certainly one of the biggest topics right now. And I've got to say, Goldman has kind of emerged as a golden child of the private credit crunch of 2026. Notably, the non-traded BDC that you oversee was below that redemption limit at a time of elevated redemptions. From your point of view, why was that the case? Is it something you're doing differently than others that got you here?
First of all, thanks for having me. Excited to be here, and thank you for that compliment. As investors, we're always very downside focused, and so we don't take compliments well, so we appreciate that, but we want to stay humble because you can never get complacent in any kind of market. I think that we were very intentional about how we set our business up. So we've been in the private credit business for 30 years. We're not new to this space. We've been through cycles, and we have lessons learned from those cycles. And so when retail started flowing in the space, we kind of approached it very cautiously, and we kind of built our business very methodically. And one of the things that we wanted to do is we have the majority of our capital in institutional style drawdown funds. So of our $180 billion of AUM, 83% of that is in institutional drawdown funds, 17% is in these sort of evergreen vehicles. And of that 17%, 2/3 of it is from our own private wealth channel, which is kind of an ultra high net worth channel where they have a lot of experience, with private assets, they understand illiquidity, and as well as institutions. The other 1/3 is kind of traditional retail. And so for us, our traditional retail exposure is kind of between 5 and 6%. And we think that matters for two reasons. One is that it's important that you kind of size your evergreen capital vis-a-vis your origination. One of the benefits we have being kind of part of the Goldman Sachs ecosystem is we have origination not just from our investing team, but from kind of all of Goldman Sachs. And so that's very powerful. When you think about this evergreen money, remember when the money comes in, the investor expects a yield. Right away, right? And so the advantage of having the majority and the vast majority of your capital in drawdown format means you can sit back patiently and draw capital when the opportunity manifests itself. And so for us, because our evergreen capital, i.e. the capital that needs to be deployed right away, is a small portion of our AUM and a small portion of our origination funnel, it doesn't really change the way that we deploy.
I want to dive deeper into that because this is an important distinction. We get asked a lot by clients, explain to me the difference between drawdown and evergreen, and what you're really saying, it feels like to me, is it's the difference of who's holding the capital in between the investment horizon. If you're a drawdown fund, you are, as the investor, responsible for holding that capital until it's called, but in an evergreen format, you, as the investor, are responsible for managing that liquidity. Is that correct?
That's right. Look, part of investing is knowing when to lean into the market and when to sort of pull back. When we raise, kind of drawdown funds, we generally have, multiple years, 4 or 5 years to kind of deploy. And if you look at the data, it's not an even line because not every month has an equal kind of amount of opportunity. And so one of the things is when you allow these evergreen capital to be too big a portion of your platform, you can get a consistent flow every month. But if that flow is very big, you run the risk of needing to kind of stretch on a deal or reach for a deal that you wouldn't have otherwise done had you had more patient drawdown capital. So I think that there's absolutely a role for it. If it's a part of your platform, it can be a valuable part of your platform. It can be a valuable way for you to deliver incremental returns to kind of the investors in that product. But it has to kind of be done, sort of with intentionally and with a purpose. And the way we've sized our capital, we think we've achieved that.
So I think a lot of people, when it comes to private credit, don't ask enough about what you were just saying, the origination engine. Talk to me about what makes your origination engine function the way it does and how you stay patient in light of any pressure to deploy capital.
We have over 260 investment professionals on our platform, so we're kind of similarly sized for other kind of independent managers of our scale. And we as a team, cover, for example, all the we probably cover about 300 private equity firms, which is kind of the bulk of where the TAM comes from. And so we originate a lot of our own deals, but we're fortunate in that we can supplement our origination from the origination of broader Goldman Sachs. And so, for example, in our investment banking division, we have 3,000 investment bankers, and they cover not just all the financial sponsors in the world, but they also cover 13,000 corporates. And so, obviously as an independent team, we wouldn't be able to cover corporates, and so we see a lot of flow there. We also have a private wealth network, and so some of our private wealth clients are entrepreneurs, they own businesses. We still see flow through that channel. And so there's a real benefit for us, and we've done this since 1996, but there's real benefit for us from having origination, not just from us, but to kind of get looks sort of through the entire Goldman Sachs ecosystem.
Yeah, how is that balance starting to change? A lot of people talk about this, where a lot of the direct lending industry really was born out of the closeness to the private equity sponsor, to lend to private equity-backed companies, but it feels like some of that is starting to change.
In direct lending, the biggest borrower in that market are still going to be kind of private, equity-owned companies, and we have a very good set of private equity clients that we lend to, and we're very comfortable lending to them. We have a long track record of lending to them, but that's not the entirety of our business. In certain of our strategies, we do sort of benefit from lending to corporates or lending to borrowers of ours that kind of come out of our PWM channel. For us, we're really looking for kind of the best businesses that have kind of sticky business models, high market share, stable cash flows. And so that can come from any channel, sponsor or non-sponsor. The majority of our business is kind of sponsor oriented because we're a big player and the bigger deals tend to come from sponsors, but we also do plenty of non-sponsor stuff.
So to that end also, you're talking about the texture of the deals themselves, kind of brings us into the big topic of the moment, software. So when you look at your non-traded BDC, you have a lot less exposure than a lot of your peers. It's still just under 20%. Some would call that still meaningful. How do you think about the software exposure you've taken on and what those companies look like in the age of AI disruption?
AI is not a new topic for us. We actually turned our first deal down for fear of AI disruption back in 2023. And we have the benefit, and again, this is where the Goldman Sachs ecosystem matters, is in addition to our deal team, and by the way, we have dedicated software investors on our deal team who've been investing in software for decades, we have the benefit of all of Goldman Sachs, right? So we have 13,000 software engineers that work at Goldman Sachs. Our colleagues in the growth equity business were early investors in Anthropic. So we have a lot of resources we can draw upon, both in the building and externally, when we kind of develop our AI framework and when we kind of evaluate software investments from an AI perspective. For us, you're actually starting to see the public market start to differentiate this fact that kind of not all software is created equal, and so there's a spectrum. If you look at the public equity market, the software index is down 30+% from the peak, and if you look at credit, the impact is much more muted, but there's still dispersion, right? So the best performing names in the leveraged loan market that are software names are down less than 1%. There are other names that are down 15% or more. And that differentiation that you're seeing is really kind of correlated to kind of what we look for, which is, to simplify it, on one end of the spectrum, if you are a company that's, you provide enterprise software that's a system of record that has, very sticky customer relationships with a high cost of switching, where you have proprietary data, that's a very different end of the spectrum than if you're a point solution that's kind of not verticalized in an industry where you're horizontal, you're providing a point solution. That's the type of business you could see AI disrupt much more meaningfully. There's a whole bunch of stuff in between. We think AI is going to be impactful, but it's not going to be a uniform impact. And so a lot of this diligence comes down to name by name, what are the characteristics of a business and what's the moat? If it's a code moat, that's probably easier to disrupt. If it's a data moat, that's harder to disrupt. And we kind of use that as part of our analysis.
So when you look at what the market moves have looked like, has the market been rational? Or do you think that actually there are investors here who have either thrown kind of too much out with the bathwater? Are you finding, another way to ask this, are you finding mispriced opportunities by areas that investors have left behind?
Yeah, look, I think that we're still in the early innings of this, and so as much access we have to resources around, sort of studying AI, there's still uncertainty, and you need to have humility when you approach this topic because it's going to continue to evolve. Candidly, in terms of new deal flow in software, it's actually pretty muted to begin with because the private equity firms, for example, are kind of spending a lot of time on their own playbooks in terms of how they're going to position their companies for AI, and we're not seeing a lot of companies change hands. So there's less activity, new activity in software software. We are spending time with all of our software portfolio companies, both with our internal team and with sponsors. Right now, today, there's actually very little that we're seeing in terms of AI disruption, but we're very, very mindful of the fact that this will continue to evolve. And so we're spending time with companies figuring out, okay, what's your AI roadmap? How are you going to use AI as an advantage? If you have data, how can you kind of use that to your advantage? So these are questions that we're in the early innings of asking. But I think in the public markets, it is encouraging that you are starting to see differentiation because not all software is created equal.
I'm really curious. One of my suspicions here is that part of the reason we're seeing such intense headlines is because lenders are kind of in the background right now working out higher rates to charge software companies in this kind of environment. How much are you seeing that happening right now?
There's limited data points, so I think we're still in the middle of price discovery. It does seem like spreads are wider and docs are tighter. Obviously the nice thing with credit is you have hard maturity. So, your loan is due on a certain day. And when your loan is due, the borrower has to refinance you or take you out or inject equity or, I think some of these deals, for example, you'll probably see more amortization than you used to, which then further kind of reduces maturity because you're getting, fixed contractual payments before maturity. So I think these are all tools that we're going to see as some of these software loans get refinanced, but we're still in the very early innings of that.
So how much disruption are you seeing outside of software then? Are you seeing a lot of opportunities to really play into disruption? A lot of clients are now asking about what opportunity is there in opportunistic investing?
Yeah, so listen, opportunistic investing is an interesting space. Some of it away from software is related to the fact that if you look at kind of the 2019 to sort of 2022 vintage of private equity, a lot of these companies have been held for a long time. And I know you've studied this, but if you look at the DPI of that vintage versus historical vintages, it's kind of well below where it's been historically. And so as you're kind of getting into 26 and 27, LPs are kind of asking for DPI. And so there's a lot of portfolio companies that have done really well. They've grown at high single digit or low double digit top line, and their EBITDA's grown and their margins improved, and they're kind of ready to sort of have an exit. But because the IPO market, for example, has been very growth oriented and excited about kind of the growth stories, some of these companies that are very, very good companies don't necessarily have a home just yet in the IPO market, and so they need to either scale a little bit more to get to an IPO, or they need to sell to a strategic. And so you have people that are kind of looking for more hybrid-y kind of capital, where they need that capital to either sort of create DPI for their LPs, or they need capital to kind of maybe buy something and grow a little bit more to kind of get to a more scaled sort of exit. And so we are seeing more interesting activity in that space.
It's interesting to see that space go more and more to the private credit market. It feels like there used to be different levers in the past. Would you agree with that?
Look, I think the toolkit's expanding. I mean, I think traditionally, if you rewind the clock 10 years, an exit was either you sold to a strategic, you did an IPO, or you sold to a different sponsor. There's obviously been some more evolution of the toolkit. Obviously, you're seeing more continuation funds happening. You're seeing hybrid capital as a tool. You're even seeing some people use NAV loans or kind of fund finance techniques as a little bit of a tool. So I think the toolkit is expanding.
What behaviors do you like, and what behaviors do you think the market could do without?
I think that it starts with, is the company performing well? Because if the company's performing well, there's going to be a home for it. And whether it's a public market home or a private market home, good companies will always be able to raise capital. And it's just a question of what should that capital look like. And so I think for us, kind of what we look for is, companies that are performing where they're growing, they have cash flow, because those are companies you can always, you can lend against, or if you want to do something more hybrid where you're maybe taking a little bit more equity exposure from a return profile perspective, that could be a good place to be.
So what do you think of the broader private equity dynamic here as it pertains to the private credit dynamic? Some people are looking at the first part of this year and saying, well, wait a minute, everyone's talking about software and private credit. Why aren't we talking about private equity and software more? What do you say to people who are not yet looking at the equity, and should they be concerned? Or is this just still too unknown to know how it's going to play out?
Listen, I think that with all of these things, whether it's public equity or private equity or public credit or private credit, there's going to be a dispersion among managers, and not all managers are created equally in private equity or private credit. And so not all software is created equally. And so I think that all this means is that you're going to continue to see dispersion because you're going to see some of these companies actually use AI to win, and some of the sponsors that have really deep domain expertise will be able to help their portfolio companies win. And then you'll see other companies disrupted, and you'll see a range of companies sort of in between. And so it is true that when you're in private credit and you're in senior secured lending and you're first dollar in, if you have a default, it means the equity in that company is worth zero. And so if you have more defaults, you'll see more software equity get disrupted. On the other hand, I think you'll also see some software companies that use AI to an advantage, where the credit will get a fixed return because obviously credit doesn't have upside, and the software sponsor will have a bigger win because they benefit from that upside. And so it's just the nature of markets.
So when you think about the big swings that you could take moving forward, right? I mean, where are the areas that you have the most conviction today?
In U.S. direct lending, as an example, we're seeing an increasingly attractive opportunity set because what's happened is with some of these retail outflows, capital has left the space. Some of the managers that are kind of really levered to that capital have kind of stepped back a bit. And so for those of us who are there that have capital, both retail and especially institutional, you're able to kind of like lean in and really price deals. And so the pendulum, which over the last couple of years had really swung in the direction of the borrower, is now kind of swinging back in the direction of lenders. And so the spreads that we're getting on deals is the best we've seen really in a couple of years. And so part of the reason that we're seeing so much institutional interest right now is institutions are seeing this kind of this phenomena happening and saying, oh wow, this is a great, we're already in private credit. This is a great entry point for us to actually lean in even more because we're now getting double-digit unlevered returns on first lien senior secured. When we kind of got to the tail end of 2025, some of these deals were having an 8-something% sort of unlevered return. And so if we can go from an 8-something% to a kind of a 10% plus type return, that's really, really attractive for that type of risk.
So that's incredible, right? And the reason it's incredible is because we've been sitting in this era where we just went through 3 rate cuts in late 2025. You had the market really talking not just about, defaults or any concerns in the market that could happen, just base rates declining. But now you're telling me actually that the market is getting back to double-digit returns on deals because so many people are leaving the market. This is so hard.
Listen, I think
to wrap
that
your head around.
when you step back, the kind of the BDC capital had kind of grown to be about 25% of the market, and so even though 75% of the market is in these kind of drawdown funds, the marginal dollar that was flowing in, that was kind of pricing deals, was sort of this evergreen type capital, and so because there was enough of it coming in, spreads came down, and so spreads had kind of been coming down really over 2024 and kind of through 2025. We're now seeing a reversal of that dynamic. The other thing obviously is with rates. There's an expectation of multiple rate cuts at some point. Obviously, as the years gone on and inflation's been a little bit stickier, some of those views around rate cuts have been a little bit moderated, and so all of that is kind of speaking to maybe a bit more of a robust environment for all-in returns for direct lending than you would have guessed 6 months ago.
Right, the pendulum is kind of swinging now because after we've had those rate cuts, now there's an expectation that there might not be any more this year. Certainly we're in a higher for longer environment given the inflationary environment that we're in, but shouldn't all that generally bode well for private credit given that we don't see that excess decline in base rates? And in fact, if you think about kind of all that's happening in the world, really what you'd be taking on then, and tell me if this is the right inclination, it's a cleaner story for investors who are looking to take on credit risk as opposed to interest rate risk.
Yeah, I think that's right. Listen, I think that you're now getting a very healthy risk premium. Now, by the way, I should say, as spreads were coming down in private credit, spreads were also coming down in public credit. So the premium of private to public was actually still, relatively intact. In fact, even this year, notwithstanding all the noise in the BDC space, the BDCs that have reported, you still see a premium, even though they're not doing as well as they did last year, they're still producing a premium to public credit. So that private to public premium is still there. But yeah, to your point now, with some of this capital leaving, those spreads are going up, and so that risk premium of private to public should go up, and so we're kind of in the early innings of that.
I'm curious about this from your perspective. You've talked to a lot of investors, even just in recent days. Do you feel that there's an element here that an individual investor, the retail investor, if you will, is kind of walking away just as the institutions are getting into what could be a golden vintage?
I think there's a little bit of a risk of that, but I think it's going to be manager specific because If you're an investor in an evergreen portfolio, it's not just about the new originations, it's about what the in the ground portfolio looks like. The good news is that there's a lot of disclosure in BDC space. Every quarter, or sometimes some cases almost every month, there's disclosure about what's NAV and what are the underlying characteristics of the portfolio. What's the portfolio companies doing from a revenue and EBITDA perspective? What's interest coverage? What are non-accruals? What are PIK? And so if you're in an evergreen where you feel like you have a really good handle on NAV, or you have a good handle on non-accruals, then it is actually in hindsight probably going to be a bad time to leave. But again, there's lots of different managers out there. And I think one of the things you are seeing is you're seeing more dispersion. And as the environment gets trickier, we'd expect to continue to see more dispersion.
So the idea here is that investors, big and small, are getting better at sussing out the good managers from the managers who are not going to perform as well in this environment.
Yeah, I think that's right.
It's going to become more apparent.
Look, I think if you look back at 2024, for example, between 21 and 24, the economy was obviously performing great, and there was a lot of new entrants, and it looked like a very wide range of managers were kind of having about the same performance because everyone's kind of getting paid the same coupon. There's well below trendline defaults, and so it kind of looked like everyone was doing the same thing. Now what you're kind of starting to see is, again, even though the overall health of the private credit system is pretty stable, and if you look at default rates, they're still relatively in line, if not lower than kind of historical levels. You're starting to see more dispersion, and so as that dispersion picks up, I think people are starting to realize, oh wow, actually not all managers are created equally. And in fact, there are differences in origination funnel. There are differences in kind of wherewithal and scale to be able to navigate cycles. And so I think you'll see that play out.
It's a moment of truth.
I think so.
Well, it's interesting for this industry because this is not traditionally an industry with a whole lot of dispersion relative to other asset classes. Do you think that this idea of more dispersion between managers will be more true as you say, there's been just much more disclosure? It gives the investor a lot more information in terms of how the funds are performing.
I think that's right. Listen, with every BDC, every quarter, you see every name they're in, and you see where it's marked, and you see the non-accrual rate. You can see how much PIK they have in their portfolio, so you can actually see that data and track that data, and I think that's a really valuable tool for investors to use.
Yeah, I wish more people were doing it, actually, because you're right. It's right there on a piece of paper. So when you think about the way you guys underwrite relative to others, and how do you think about conservatism versus risk-taking in this environment? A lot of people will look around and say, well, it's not just AI, it's also supply chain issues are probably, coming from months ahead of us. What are you worried about? And where do you feel like you're taking on risks that others are not able to at this time?
Listen, as I said earlier, in credit, you don't have upside, you only have downside. So you have to, it really comes down to credit selection, and credit selection is a function of underwriting standards. And so what we look for is, we want to lend against leading businesses that have good market share, defensible characteristics, cash flow generation, stable, kind of recession resilient. We are not in the prediction business, we're in the preparation business. And so we have been at our investment committee, kind of stress testing for sort of what a recession would look like for many, many years. And so we stress test our portfolio. We try to make sure that we have structures that kind of protect us in a downside case. And we try to pick good businesses that are stable, that aren't kind of levered to some of the kind of cyclicality that you could really see turn the other way in a recession.
Yeah, I'm curious about some of the practices that evolved, given that we've had such a benign environment for so long. A question we get asked a lot is good pick versus bad pick. Mm-hmm. How do you think that those practices might start to evolve across the industry and the use of pick?
Yeah, it's a good question. We track the PIK data, not just for us, but for the whole industry. I agree with your characterization. I think there's a big difference between PIK at origination versus PIK upon a restructuring. In the former, when we've had an opportunity to
PIK
diligence...
PIK is payment in kind, for those who don't know.
Thank you for clarifying. For borrowers where they have a business plan, well, let's say they're building a factory, and it's going to take them 4 quarters to build a factory. And we have a chance to diligence the factory, to diligence the revenue, the incremental revenue that comes once the factory's built. And they say in the upfront, they're like, hey, can we have a loan where for the next 4 quarters, we're going to be building this factory. Can we pick a portion of our interest? And so in that case, let's say the interest rate on that loan was 9%. if we're picking 2% of that 9%, for a year, and we're getting paid, let's say, an extra 50 basis point for it. So we would have charged 9%, but now we're getting 9.5%. Or
you're basically
we would have
rolling
charged
over the interest to the end of the payment.
Exactly, or if we would have charged 10%, we're now getting 10.5%. And by the way, we're still getting 8 or 8.5% of that 10.5% in cash. Then the one way to think about it is, if we're getting a 200 basis point premium to where the public comp would be, and we're still getting cash pay equivalent to the public market, and all we're doing is we're picking the premium to the public market in a business we've had an opportunity to diligence and trust, and upfront we know that going in, then we're okay doing that. Not for everybody, but for certain business plans. The opposite of that is if a company like runs into trouble, and they knock on your door and say, hey, I'm having some trouble, can I restructure my loan? Obviously that will happen in the course of a life cycle of a fund, and so that's pick upon restructure. For us, if you kind of look at our portfolio, our total income from PIK is about 3.1%. 3% of that is the pick upon origination, so that's the pick, and we knew that was going to happen. And only 1 out of our 184 companies falls into that latter category. And so overall, our pick levels and our sort of certainly our bad pick levels are at the very strong end of the industry, and that's something we continue to monitor very closely.
Right. Do you think that the industry has kind of used it too much as a practice? Is really my question. As an industry.
Yeah, listen, I think one of the challenges is that not everyone actually discloses those two buckets. And so one of the ways you can kind of get at it is we'll look at, okay, if a loan is marked below 90 and it's picking, there's a pretty high chance that that's not an intentional pick. And so you can kind of sort of look at that measure. I do think that if the cycle were to turn and get trickier, I do think you'd see the market kind of pull back on sort of pick optionality. But I think we're kind of in the early innings of that.
Right. I know you had earlier said Goldman does not see high recession risk by any means at this point in time, but to the extent that you are concerned about the world risk managing, what should investors be looking out for when they're stress testing a business, when they're talking to the managers and asking, are you protected against X, Y, and Z? I
think there's two parts to this equation. One is origination funnel. So I think it's important to understand origination funnel and composition of capital, and is the manager set up where they can sit back and be patient, or are they set up where they kind of have to deploy because the nature of their inflows means that they have to deploy? And so, and how does that compare vis-a-vis their origination funnel? How broad an origination funnel do they have, and what kind of looks are they getting, and how many boots on the ground do they have to kind of find new deals? The other part of the equation is kind of the investing process, right? Who's doing the diligence? What does the diligence look like? Do they have the requisite industry expertise? Have they been tested through cycles? When you go through a cycle, you're going to have some names that get a little bit trickier, and guess what? You learn a lot from kind of working through those sort of tricky names. And so I think investment process and diligence and the kind of the experience level of the team. By the way, even the best managers are going to have some names that they get wrong. And so what are your workout capabilities? That's really important, because one of the things that you see is real workout expertise can make a difference in recovery value, when a loan does go wrong. And so I think those are the questions that I would really focus on top of just the metrics that are publicly disclosed in terms of, okay, what is your, what are the underlying, metrics of your portfolio? What's your non-accrual rate? What's your pick? What's your good pick versus bad pick? Those sorts of indicators.
When you look across the industry, a lot of people look at this moment in time and say, well, okay, redemptions have been elevated. Some people will say, okay, did investors understand the liquidity profile? Did they not? Now I think it's much more well understood that 5% liquidity cap. But there's another group of investors that'll say, well, a lot of this is just, us not understanding or knowing what default rates will look like, what they will rise to. When you look at this early part of 2026, what have we learned? And is there anything that you think is myth versus truth in the way that investors kind of have behaved around the private credit industry? In short, what is a real concern versus what is something that has been overblown?
I think that it's important to separate technical from fundamental. I think what we've seen so far this year has really been more technical than fundamental. So in other words, again, the state of we are starting to see more dispersion, and so it's worth keeping an eye on. And some managers are underperforming, and so that's worth keeping an eye on. But the overall health of the market is actually in a relatively solid place. The biggest story has really been this redemption phenomena for that BDC part of the market, which is obviously just one part of the broader market, but it's an important part. And I think that some of that is related to the point that you mentioned earlier, which is, did people people understand the liquidity on the way in. We were very careful when we set up our business that we didn't use the word semi-liquid. We understand what people mean when they use that word, but we didn't want to use that word. We call them evergreens because the reality is this is not semi-liquid, it's not half liquid, this is an illiquid asset class. Part of the reason there's a premium for private credit versus public credit is for that illiquidity. And so while there is better sort of interim liquidity on a best efforts basis relative to a drawdown fund, investors should really think about this as being the illiquid part of their portfolio. And so we think that one of the reasons that we've been fortunate that, our redemptions have been kind of better than the industry is because of the composition of our investors, the fact that 2/3 of them are institutions and our own, kind of ultra high net worth channel who they understand alts and they've been investing in alts for a long time. And then on the 1/3 that's not, we've been very intentional with the RIAs that we've partnered with, making sure that we're partnering people that will use our marketing materials, that will really kind of explain the nuances of that kind of illiquidity. For people that are prepared and have the wherewithal for that kind of illiquid portion, we think it can be a really powerful tool, but it's really important to make sure that you understand that going in.
So I want to spend the last part of this conversation really talking about private credit 2.0. I think for too long, people have only talked about private credit as though it's direct lending only. Just paint a picture a little bit about where this market is going and some of the new types of approaches that are happening. People have talked about asset-based finance. We started to talk about opportunistic. What's next?
Listen, I think that the fastest growing area of private credit from here, and we're already seeing this, is actually going to be exactly what you said, which is kind of in the private investment grade space. So to frame it, right, the high yield market, the leveraged loan market, the direct lending market are all kind of $1.5–1.75 trillion type markets. Those are scale markets. They're here to stay. They'll continue to grow. But
I
think
a slower growth rate, right? By definition.
Yeah, listen, I think that's right. I think that there's, the entire universe of below investment grade is obviously, all that stuff adds up to, whatever, $4.5 trillion. Maybe that'll grow to 5 or 5.5 or 6 over time. But that's only kind of one part of the economy. The investment grade universe is a much bigger part of the economy, and asset-backed finance is a much bigger part of the economy.
So how big what's your kind of estimate there of the TAM?
Yeah, listen, there's different estimates out there. There's been different kind of research reports. I think that it's going to be a multiple, and so and it depends a little bit on what you're measuring. If you just look at the 4.2 private placement market for kind of the initial kind of private IG market, which is largely an insurance company market, that is already a $1 trillion market. I've seen estimates that if you look at, kind of ABF that doesn't sit on bank balance sheets, so kind of like non-bank liquidity providers and insurance companies and other types of players, like that TAM is a, $6 trillion plus TAM. There's other estimates that say that, when you think about all the CapEx that's getting spent on not just AI, but kind of on the sort of things adjacent to AI. So, obviously there's going to be a need for more data centers, but more power plants to power those data centers, transmission line upgrades, that's going to lead to a lot of infrastructure financing. So when you kind of add all of this stuff up, I mean, there's estimates that, are in the double-digit $1 trillion in terms of what this TAM could kind of grow to over time. Whichever one of those research reports or estimates you want to look at, all of it is a multiple of the size of direct lending. And so I think that we're in the relatively early innings of it, but it's kind of the same thesis, which is borrowers who have these large CapEx projects are willing to pay a premium for customization, for finding a solution that they can't get in the public market. And so if you think about private credit or you think about direct lending, borrowers being willing to pay, whatever, 200 or 150 or 175 or whatever it is, basis point premium to public markets, you kind of see the same thing in private IG. Now, the overall yield is lower because obviously the starting point is lower in terms of IG spreads, but it's a real opportunity for people who want IG exposure in a more illiquid format to get a premium to what they would have otherwise gotten in public markets.
If I may, I think that one of the things that feels remarkable to me is that, there used to be this push-pull between, private credit versus the banks. Now that tension didn't really exist in the same way at Goldman because you have private credit and you have an investment bank, right? Two different businesses, you do both. But it does feel to me that what's remarkable about what you're saying is that actually this newest wave of private credit is directly in one of the biggest businesses that has historically been kind of this historic Wall Street business of underwriting. Do you think, what changes, right, in terms of how the private credit world interacts with the banks as it becomes kind of a bigger part of what banks used to do?
I think this is just the continued evolution of a journey. So, like, when I got into the business, there used to be the paradigm used to be like a term loan A market. Frankly, before there was a term loan B market, and then obviously there was kind of the high yield market. And the concept was banks kind of clubbed together the senior secured loan, and they held it on their balance sheets. And then for additional kind of more junior capital, the sponsor could go out to the high yield market and sort of go to bond investors. The term loan B market, obviously, and the CLO kind of phenomena started growing really in the late 90s. And then you kind of got to a market where banks' role evolved a little bit. So rather than holding the loan, they maybe held the liquidity facility, they'd hold the revolver on the balance sheet, but instead of being the storage, they'd be the warehouse. So they would underwrite a loan for distribution into the public markets. And that market they'd syndicate the loan. And that's a big market. That's where the term loan B market comes from, is it's bank originated paper that they sell into the public market, CLOs, mutual funds, loan mutual funds and the like. And so this is just a continued journey where I think banks will always have a really important role to play in the origination, because banks do have wide origination footprints and they cover not just sponsors but corporates. It's really hard for an independent alternative asset manager to cover a corporate because they only have one product to offer. Banks obviously have a lot of services they can provide to a corporate. So I think that banks will continue to play a really important part in the ecosystem. I think there'll be plenty of opportunities for banks to use their balance sheet in the ecosystem, but I think you'll kind of see the private markets continue to grow alongside the public markets as being an outlet for that origination.
Yeah, we've learned already that both things can be true, right? And now that's just happening on a much bigger scale, private and public credit. Wild. Well, anyways, Vivek, thank you so much for joining us. That was Vivek Bantwal. He is the co-head of private credit at Goldman Sachs, and you've been watching The Bridge by iCapital.